Hello everybody, today will be our 40th lecture series, and I've mentioned in my Facebook as well as my YouTube and in my LinkedIn handle profile that I'll be delivering a session on the mutual fund. I've already given you a session on the mutual fund, but it is a kind of a recap I'm again starting because I've got some requests from my friends regarding the various investment opportunities which are available in the context of mutual fund for the investors, for the retail investors as well as for the institutional investors. Now, in order to understand the mutual fund, I'll give you a little bit of recap of what I've told you in my earlier, and in my next series also, which will be on the mutual fund, I'll be discussing how to invest in the mutual fund and what are the schemes that we need to understand in order to invest our fund across the mutual funds. So, mutual fund is actually an investment fund, and that pools money from many investors to purchase the securities. Now, the term is typically is used in the United States, in Canada, as well as in India. Well, similar structures across the globe, and in any kind of open-ended investment company in the UK. Now, mutual funds are often classified by their principal investment, that is money market funds, as well as bond or fixed income funds, or stock or equity funds, or hybrid funds. Now, funds may also be categorized as the index funds, which are passively managed funds that track the performance of an index, such as stock market index or bond market index, or actively managed funds. So there are many categories of the mutual funds that I will try to focus on, and which actually seeks to outperform the stock market indices but generally charge higher fees. The primary structure of the mutual funds are open-ended, close-ended funds, and the unit investment trust. Now, over long durations, passively managed funds consistently outperform actively managed funds. Open-ended funds are purchased from the sold to the issuer at the net asset value of each year as of the close of the trading day in which the order was placed, so long as the order was placed with a specified period before the close of the trading. They can be traded directly with the issuer. Now, mutual funds have some advantages or disadvantages as compared to the directly investing in the individual securities or in the equity market or the secondary market. Now, the advantage of the mutual funds include economies of scale, diversification, liquidity, and professional management. As with the other types of investment in the mutual funds involves various fees and expenses. So, mutual funds are regulated by governmental bodies and are required to publish information including the performance, comparison of performance to benchmark, fees charged, and the securities held. And a single mutual fund may have several share classes for which the large investors pay the lower fees. Hedge funds and exchange traded funds are not typically referred to as the mutual funds, and each is targeted at different investors, with hedge funds being available only to the high net worth individuals. At the end of 2023, the open-ended mutual fund asset worldwide was something like $69 trillion US dollar, and the countries with the largest mutual fund industries are the United States with $38 trillion, 39 I should say approximately. Luxembourg were called $5.8 trillion. Ireland, China, Germany, Australia, France, Japan, United Kingdom, and Canada. Now, in the United States, as of the end of 2024, 24% of the household financial assets were invested in mutual funds. Now, almost half of the US mutual funds assets were held in individual retirement accounts, plans, and other defined contribution retirement plans. Mutual funds accounted for 38% of the individual retirement accounts and the 60% of the assets. Now, Luxembourg and the Ireland are the primary jurisdiction for the registration of the UCITS funds. Now, these funds are actually sold to the European Union and other countries that have adopted mutual recognition regimes. The first modern investment fund, the purchasers of the mutual funds, were established in the Dutch Republic in response to the financial crisis of 1772 and 1773. The Amsterdam-based businessman Abraham Van Kuich formed a trust called Egermarkt Magnet, Unity Creates Strength, and his aim was to provide a small investors with the opportunity to diversify. In UK, one of the earliest collective investment schemes was with the Foreign and the Colonial Government Trust, established in the London 1868, widely regarded as the world's first investment trust. The first investment trust in the UK, the Scottish American Investment Trust, formed in 1873, which is considered the most obvious progenitor to the mutual fund according to Diana B. Higgins. So one of the earliest investment companies in the US, similar to the modern mutual fund, was the Boston Personal Property Trust that was founded in 1893. However, its original intent was a workaround to the Massachusetts law restricting the corporate real estate holding rather than investing. Early US funds were generally closed-ended funds with a fixed number of shares that often traded at the price above the portfolio net asset value. Now, the first open-ended mutual fund with the redeemable shares was established on March 21, 1924 as a majority investment trust, which is still in existence today and managed by the FMS Investment Management. Unlike earlier closed-ended trust that trade at premium or discount to the net asset value, majority investor trust introduced redeemable shares priced on the underlying portfolio value, establishing the core structure of the modern open-ended funds. In the US, there were nearly 6 times as many closed-ended funds as the mutual fund in 1929. Now, after the Wall Street crash of 1929, the United States Congress passed a series of acts regulating the securities markets in the general and the mutual funds in particular. Then comes the Security Act 1933, Security Exchange Act 1934, Revenue Act 1936, and the Investment Company Act 1940. Now, these regulations were development of the open-ended mutual fund as opposed to closed-ended mutual funds. In 1936, US mutual fund industry was nearly half as the close of the investment funds, but mutual funds has grown to twice company by company, twice as large as the close by 1947. The first real index fund appeared in 1970, aiming to capture the average market returns rather than doing detailed company by company analysis as the earlier funds. Beginning in the 1980s, the mutual fund industry began a period of growth, according to Robert Pozen and Theresa Hamsek. Growth was the result of the 3 factors. Number 1 factor was the bull market for both the stocks and the bonds. New product introductions and innovations like the municipal bonds and the various industry sectors, international funds and target date funds. Wider distribution of the fund system. Among the few new distribution channels were the retirement plans. Mutual funds are now the preferred investment options in certain types of investment plans, especially in this one. 2003 mutual fund scandal involved unequal treatment of fund shareholders, whereby some fund management companies allowed the favored investors to engage in prohibited late trading and the market timing. The scandal was uncovered by former New York Attorney General Eliot Spitzer and led to the increase in regulation. Like other types of investment funds, mutual funds have advantages and disadvantages compared to alternative structures or investing directly in the individual securities. According to Robert Pozen and these are what are the advantages and the disadvantages of the mutual funds. So I will discuss in my next lecture series the advantage and the disadvantages of the mutual funds. Thank you very much for watching.